We're on the Vanguard trading desk. Here it is behind me. 22 traders trade north of $2 billion every single day. Great privilege to be here. Tim Buckley's the CEO, runs the whole operation. Thanks for joining us.
My pleasure.
It has been a really tough October and November. A lot of volatility. As the head of Vanguard, what are you seeing? Tell us what kind of flows you're seeing. Is anything unusual going on in your mind?
Well, Bob, I'd say what you're seeing is the return of volatility to the market. That's something that is normal to see that kind of volatility. So as a result, hey, investors are being wiser. They're being wiser. They're not just piling into equities. They're being more balanced with their flows. And I would say for the past 6 months, they have taken risk, like a bit off the table. They used to be piling really into risky assets, not doing that so much anymore. Flows in the industry are down overall.
Yeah, we had huge flows 2016, 2017. The flows are still positive this year, but not as big. I think we're about half of what they were. Why are people not putting as much money into the market? Is it too volatile, or the valuation's too high? What's the issue?
Well, it's a little bit of all the above. We started the year with very high valuations and went up from there. And people got a little bit more conservative then. We had kind of a frothy market, so equities saw a little downturn in flows. And so people came off, and flows are down about 55% in the market overall. Yeah. And we're seeing ours are off about 40%.
But still up.
But people are still,
right?
It's still way positive. I mean, we're seeing $200 billion in flows so far this year.
Yeah. How about you're releasing your 2019 economic outlook next week? You just had a preview of it today. Tell me what you see happening in the next year in the markets. One of the things you've emphasized in the last month, I've seen your comments, expect lower returns, not just next year, but for the next several years. Why are you pushing that idea right now? What's the thought process?
Well, Bob, for us, it's really a math equation. When you start off with higher valuations, you're just going to get lower returns going forward. And the markets have come down a bit, and we were in frothy valuations. You're now simply dealing with high valuations. So if you start at a high point, it's tough to imagine a lot going forward unless you have serious economic growth, and companies can do extremely well. We've already had a fiscal stimulus. There's a lot of volatility in the marketplace because people are worried about what's going to happen. What's going to happen with the tariffs and such. So there's concern out there. Unless you think that for some reason, hey, companies will do a lot better. So the tariff fear is going to go away. Productivity is going to jump. Then companies will do very well. Then the markets could take off. But the consensus would be like, hey, expect less on the returns. And I'll tell you, if you expect less, what do? You save more.
Yeah, that's going to be an issue.
You'll never regret
When you say expect less, you're expecting still what, 4%, 5% annual returns? Give us a number.
We would expect, say, a balanced portfolio, you're going to be looking at about 5%. 5% for a balanced portfolio. Okay. And that's way off what people have used to 8 to 10%. Yeah. People have been investing for the past few
decades. That's been the average for the past 7 or 8 years. I got to ask you about the fee wars. I know this is a little silly, and it's like watching a baseball game. You recently lowered the minimum on several dozen index funds. I think we're down to 4 basis points on a lot of them now. Mm-hmm. Fidelity, your competitor, over the summer, they launched a series of zero-fee products. People seem to respond to this. Why is it? We're getting to the point where 4 basis points, how low can you go at this point? And yet people still respond to it.
Well, Bob, we're a big believer in low cost, and we're glad the marketplace is finally embracing it, at least partially. I mean, it's kind of what we're built on, that if you can lower costs, people get to keep more of their returns. It's something that since I joined Vanguard, look, we've done it thousands of times, lowered the cost of our funds. And each year we'll give back about $200 million to our investors in different ways of lowering costs of expense ratios. We return that to them. So they get more of the return. Can you get closer and closer to zero? We're built to be asymptotic to zero. We're owned by our clients, so when we do well, we give back to the clients. So we think we can go lower and lower. And I mentioned that people are embracing it. They're at least embracing it partially. People are lowering costs where they compete directly with Vanguard. Yeah. Over the past 5 years, they've lowered costs, say, 308 times where they compete with Vanguard directly. Unfortunately, they're not lowering cost in their other products, in their other funds.
Yeah, your point is get the active manager guys to lower the fees more.
Then they'll actually they might outperform the market then.
Yeah.
Lower the cost, lower the expense ratio where your clients actually have money.